Am I coming in now? I think I had a technical issue on my end, so give me 1 second. Let me pull all of this back up. All right, are we coming through? Awesome. Thanks for your patience, guys. Appreciate it. All right, so what we are going to do is we have a lot of really interesting things happening in markets today, especially on an intraday basis with S&P falling a little bit, bonds bidding, the VIX made a little bit of a new intraday high. A lot of interesting things taking place. So wherever you're watching this, I'd really appreciate it if you could just like and retweet, reshare everything on Twitter, and then in the YouTube comment section, if you can throw something, let me know that you're here. You can throw questions in there. I'm always reading all the comments, and I'll try to cover things in real time just to kind of break down how I'm thinking about macro views and everything else. So that is what we're going to be covering today. The key thing that I want to announce just before we really get into a lot of the macro views and before I start explaining that, because I'm going to go over macro views, and then I'm also going to go over the changes that we're seeing in the market today. Going to cover Bitcoin and everything else. But the key thing, just so that everyone is aware, on the Substack, if you're on the Substack reading all the research there, I just sent out a notice yesterday that on Friday at market close, the prices for the Substack are going to increase to $135 a month or $1,300 a year. So if you lock in the price before then, you get grandfathered in at the lower rate. So $125 a month or $1,200 a year. And as long as you stay active on there and keep it locked in, that price will never change for you. And then all the new products and models and all the things that I release on the Substack and everything like that moving forward, you get access to all of those and everything I publish on the Substack moving forward. So in this section right here, and if you're trying to find this article, if you go on the Substack, it was published yesterday. And you can bounce from here 650 now. That's just the squawk. You can go there and you can find all the details for that. And then also linked in this are, if you subscribe today and before the Friday market close, I attached 2 kind of bonuses for everyone. And those are a macro report that explains how should you think about the different changes that are taking place when we don't have government data. And I walk through what are the all high quality alternative data sources that we can be using to be able to map what is taking place. Because for everyone who's in markets, all of us are using a lot of different data points to extrapolate and to nowcast and to basically triangulate what is taking place on a macro basis, right? So, there's a lot more people that do this in a lot more sophisticated manner than I do, just because it's so data intensive. And, a lot of hedge funds are spending, just tons of money every single year for everything that is happening for all their proprietary data. But, be aware that, people will take all of these metrics and say, okay, well, how many visits are there to the Walmart website, right? How does that correlate with sales? How does that change consumption patterns? And again, when you have, I went over this in the report actually, but when you have Walmart breaking to all-time highs and everyone go into their website, you have a lot of more changes and things like that. That's not an environment where things are collapsing. That's not an environment where the underlying economy is deteriorating. Are we softening a little bit? Yeah, sure. There are some changes. There's a reason why we have bonds bidding a little bit. But broadly speaking, we are seeing resilience. And so that is, I cover all the specific signals for that. And I really dig into the logic for how to think about this period of time we're moving into without government data. And then I also attached a risk taker's manual, which is just all of the main principles I think about for taking risk and how I think about managing a hit ratio and a risk reward and how to develop knowledge of markets and how to connect all of those things incrementally. And so all of that is laid out, and you get to have access to both of those if you lock in the price today. And then you can also do a free trial, which will allow you to lock in the price today. You can review all the research. If you decide that you don't want to do it, there's zero downside, and you can just cancel before the 7-day free trial is up, and you get all the upside of just all the research and everything else. And what I will say just for everyone, right before we get into macro views is just go through all the educational primers on the Substack before you go through everything else. Like, you don't need to become a paid subscriber right away. You can go through all the educational primers on the Substack that I've written, and the entire point of them. And if you just go to the main page right here, you have in the main section all the educational primers. If you just go through all those, they're all free. There's a ton of things that just help you set a foundation for how to think about macro and markets. And you'll begin to see why that's important, because in the Bitcoin report that I just wrote, explaining how macro liquidity impacts Bitcoin and how it's related to gold or silver or equities or things like that, if you understand the underlying changes that are taking place from a first principles perspective in the educational primers I laid out, then you'll begin to understand why Bitcoin or other assets are moving in the way that they're doing. And so I would just encourage people, don't even become a paid subscriber right away if it's not the right time for you. Just go through all the educational primers, and they're all free. I always make all the educational material on the Substack 100% free. And a lot of that comes down to the quote that I always share from Good Will Hunting, which is, you wasted $150,000 on an education you could have got for $1.50 in late fees at the public library. And the reason why I share that is because we are in a period of time that is just so unique, where the amount of distribution of knowledge across every single sector in the economy is happening at such a rapid pace that the people who might have had a little bit of an edge because they, know basic marketing techniques or some basic information flow in markets or something like that, that is becoming less and less valuable. Even major funds that are, really running a lot of money, they're, all of the different informational edges that they're running, a lot of those are beginning to provide less and less value, just because a lot of the information that they have, the same alternative data that you might have had, 10 years ago doesn't work today, right? Like, things shift so much. And so those are the things that I would just encourage people to check out. Again, if it's not the right time, don't become a paid subscriber. Do what's best for you. But there will be a price increase on the Substack on Friday at market close. So if you lock it in before then, you can go view all of that. All right, let's talk about markets and where we are with the S&P, where we are with bonds. And let me explain to you my macro view. So broadly speaking, what we have seen since the April lows is a really clear and consistent injection of credit into the underlying economy. And also, we have seen an injection of liquidity in financial markets. We have seen the Fed now cut into resilient growth. And that has been one of the key factors pushing equities higher. And we've rallied pretty significantly off the lows in April, and we've moved up this entire time. And this entire period of time, we had the drawdown in equities functionally pricing a recession on tariff risk, even though the labor market was pretty strong. I mean, the labor market was even stronger back in April of this year than it is now. But since that time, we have had even more credit get pumped into the U.S. economy. And I've laid out in all the research that I've put out explaining how we are seeing, in the underlying economy, a lot more people invest, especially as it relates to AI, data centers, or anything like that. And so what we have seen over the last 3 months is a consistent trend to the upside, and especially this compression in vol. Right? And this compression in volatility, which just means we've had a tighter range in the S&P 500, has allowed traders, myself included, everyone, to be able to have positive returns, tighter stops, and you can use more leverage. That's why it's not incredibly surprising that you have this move down. This move down that we had on Friday was a little bit bigger than I expected, but it was driven primarily by a bit of a position unwind and also the dynamic with the US and China on the tariff risk. And if we just zoom in here a little bit, let me break down a couple things. We had the tariff risk that pushed equities down. and it really over extrapolated things to the downside in my view. And the key thing that I would note is that, I noted this on Friday, that my view was that we're probably going to have, green days on Monday and Tuesday, and we're not going to have some really significant gap down. That was my view. We gapped up and we've been chopping in this range. And then on the overnight session the other day, we had some negative news from Xi on just, again, going back and forth on rare earth materials and how China relates to the US and things like that. That caused the S&P to sell off a little bit. We mean reverted back into the US session. We've pushed up higher. Again, more negative news that mean reverted back up. And then we're coming down a little bit on the day right here. And we have the VIX specifically making a new high, which is a very interesting kind of new development that we have seen right here with a lot stronger implied volatility. Give me 1 second. And let me pull this up. Hang on. All right. So we have, ES moving down a little bit on the day. And then we also have the VIX making a new high. And then we also have, notice that we have ZT bidding right here. And we're back up to these high levels. This is important because right now, and I'm going to pull this over so you can see the probabilities in real time of how aggressively we're pricing cuts on the forward curve. 1 second. Kind of multitasking with a couple things. Give me a second. All right. So you can see here that we are now pricing 100% probability of a cut in October, which we kind of already know, a 107% probability of a cut in December, which just means that we're pricing a 7% chance of a 50 basis point cut. And then now a 58% chance of a cut in January. So we're just pricing more rate cuts across the curve. And as that happens, the more and more rate cuts that we are pricing, it's overlapped with some equity selling pressure, right? And some of this is surrounded around the tariff news. Some of it's just surrounded around positioning unwinded as well. The key thing that I'm watching is the fact that bonds have actually maintained their bid this entire period of time as you have more rate cuts priced on the forward curve. And I'm going to go down to the curve right here. The fact that we have not seen the curve steepen significantly, especially bear steepen, is really important. We're a little bit bull steepening on the day right here, but broadly speaking, for 10s, 30s, we're still kind of in this range right here, right? We have some bull steepening on the day, but we're in this range right here, and we have flattened pretty significantly over the last couple months. What does that mean? It means that we are in a period of time where the long end is not yet sniffing out any type of inflation risk. So if you have the Fed cutting into elevated inflation, you can have the longer end sell off, right? Which just means that if you price more cuts and you try to push up, the Fed tries to push up or push down, short end rates, and that pushes up ZT. You can have the long end bid less because it's saying, well, yeah, the Fed might be pricing cuts, but longer term, we know that it's going to result in inflation. We have not seen that yet, mainly because the most recent inflation prints have come in flat, and we have seen just a little bit of slowing in the equity or in the underlying economy. And then we had this whole tariff thing that caused a little bit of selling pressure in the S&P. Now, the entire question is, if we move, the fact that we had just the Russell move to new highs almost immediately, we had, off this gap down from the tariff news, we had the Russell move to an all-time high, right? Like that is a very bullish sign for the U.S. economy, not the kind of thing that you would expect when things are collapsing and falling apart. So, all of these different things are sending the signal that equities likely have support here, right? My view is that we're going to remain above, and I laid this out for paid subscribers previously, before we even rallied further, that, I think we're going to remain above these, the gap down levels. If we didn't, that would change some of my macro views. And so, we have the S&P, we're still making we're still kind of holding these levels right here, especially, in the overnight session right here when, Xi talked and, put out some more information that was negative for the tariff news. That mean reverting back up is very positive overall, right? So that is what we have been seeing here in equities. You'll notice today when we have this, push down, I'm watching all these moves. You'll have gold bid, and then you had silver. We had a little bit of a, kind of selling pressure here, but then it mean reverted right away, and we moved right back up. And the fact that gold and silver keep bidding, even in these, position unwinds and equities and things like that, is just an indication of how much buying pressure there is. A lot of people are getting super net long, the gold and then also the gold miners just really aggressively. And part of that is due to the setup that we're at with bonds, because it's going to be tough for bonds to rally really significantly here because of where we're at with growth and inflation and the Fed stance. When you have the Fed cutting interest rates into growth that is not collapsing. So, right, like the labor market is not falling apart right now. There's some normalization. And here, let me pull up a chart that'll kind of help you see this a little bit more and depict this in a clearer view. Let me pull this up. Hang on. Perfect. Here we go. All right. That is too small. All right. So when we have, here's just some real-time view of what we're at with growth right now in the U.S. economy. This is just the Bloomberg, second measure U.S. consumer spending data that shows kind of a weekly real-time view of consumer spending. And the setup that we have is that growth still remains positive and resilient overall, right? We're at a decent level still. And, last time we had the Atlanta Fed Nowcast data, we were running well above 2%, right? When you have GDP running at 2%, and we were actually at, closer to 3%, when you have GDP running at that, we've only had the absence of government data for about a month now. It's very challenging overall to have GDP contract by 3%. So to go from 3% to 0. It's very challenging for it to move that much in the span of a month without anything actually fundamentally changing. When you have a move that large, that's, it's usually from an exogenous shock, something like COVID or something else that's not going to be reflected in data, but you look out your window and you're like, oh yeah, something's clearly changing. So what we are seeing with gold is that it is pricing the differential between several different things. Number one, and this will be important to understand for Bitcoin, but number one is the Fed cutting rates into an accommodative environment of growth that needs to be priced, right? And so that needs to be priced in real terms, which is why gold and silver is rallying. They function as a liquidity release valve for macro liquidity, specifically as it relates to duration risk and the amount of any type of devaluation connected to real rates or the quantity of money in the system, right? And gold has a specific role in that. I know a lot of people don't like to hear this, even though it's just what the price says. But, gold has a relationship and a stance in the system that Bitcoin does not. And, currently, gold is held on central bank balance sheets. Bitcoin isn't. That's why you can have gold bid in periods where equities are selling off. I mean, during this entire period of time in April, you'll notice that we had the S&P sell off as gold was rallying, right? And then, you've had that same thing happen in the little pullback that we've had more recently. So those are just facts, right? Of how the entire system is set up with asset liability relationships. Bitcoin is still correlating with equities and right now underperforming equities, which is supposed to be a signal into the type of system that we have right now. And my view is that the system that we are in, it is one where you're shifting the entire global trade system, or where the current administration, Trump, Besant, and all of the guys that they're trying to pull in, they're all trying to shift the entire global system. And that is the dynamic that we have with the trade war with China right now. And it's very challenging for, two major countries like the United States or China to have an actual, kinetic war where there is actual physical violence or something like that. Maybe there's things that are happening, behind the scenes in special operations or something like that that none of us know about that are, classified. But, we're not in a actual physical altercation with them. And if you have that, you have to remember that China exports the majority of the world's goods, especially for the United States, to everyone, right? So if you get into conflict, you're going to destroy both economies, right? And so the result is, okay, instead of a physical altercation, there is just this new era of asymmetrical, informational, and economic warfare that is taking place. That's really what financial markets fall into. And, a lot of people are not going to talk about that. Well, you actually will, but you'll have a little bit of a silo of knowledge. I'll explain how that works. What we see is that a lot of the people that actually trade markets or understand markets, they don't like being political, right? Even if you're just talking about geopolitics, they don't like being political, right? And, nowadays, if you talk about anything, especially as it relates to informational warfare, that's just kind of all relegated to the political accounts, right? And it's something that people are like, oh, we don't think about that. All we need to care about is the price and things like that. And there's kind of this virtue signaling around not being political or something like that. And then on the other side of the spectrum, you have people that just kind of go deep into the conspiracy theories and every single little thing, but they don't connect it to markets and they don't even understand markets, right? And seeing the things that are taking place with gold rallying this amount. I mean, this is, one of the most significant rallies we've had, just even in history. I mean, look at this move has just been massive, right? And this is an indication of where we are at on a geopolitical basis, specifically as it relates to our relationship with China. And let me pull a couple charts just to kind of depict this a little bit more, because if you understand the setup with China and how they relate to the rest of the world, you begin to understand the building blocks for the entire global system. So let me pull up the US current account as a percentage of GDP. And you'll begin to see, current account is just imports, how much is the US importing versus it's exporting. And right now we're importing way more than we're exporting, and as a percentage of GDP, right? So the deficit is running at about 6% of GDP right now. And then, the current account is running about 4%, right? And so let me now pull up the US current account in absolute terms, and you can begin to see where we are on a bigger picture scale. So as a percentage of GDP, kind of think about it as like debt to GDP, right? As a percentage of GDP, okay, we're at, 4.3%, right? Like that's back down to kind of almost where we were at when China was industrializing and they were changing a lot more things in this downward trend here, which actually, if you understand the liquidity and credit changes that we had in the run up to 2008, this trade relationship is one of the major factors that caused the 2000 bubble and also the liquidity injections that created the financial crisis that we had at the time. People don't like to talk about that as much because they just focus on housing because it's a little bit easier to understand. But, you created a certain adjustable rate mortgages and all of these other garbage products and things like that. Well, not adjustable rate mortgages. Mortgages are not garbage in themselves, but those, and then all the CDOs and everything else. But then you still needed to have money to buy those. Where did that money come from? And part of that is connected to the cross-border flows and the amount of liquidity in the system. Here is the current account on an absolute basis, which just means not as a percentage of GDP. And you can see that we have just been making new lows over and over and over since the 1970s. And what I would say is that this chart, combined with some actions by the Fed, and then also some other factors with government spending and also commercial banks, but a lot of it comes down to the dollar's reserve currency status. That is what is driving liquidity in markets, and also what is driving the amount of inequality that we see in the system right now. Everyone likes to, complain or whatever else it might be about how houses are unaffordable, or that no one can afford anything, or whatever that might be. What the driver of that has to do with the dollar's reserve currency status, because you are creating this open capital account for the United States where you just have a free market, right? Not just for us, but for every foreigner that wants to invest in U.S. markets or import goods or services, right? So that's why when you begin to shift that system, you have massive moves like this, right? Because that has been the staple in the system for years and years and years. And, I would say that one of the major reasons why crypto exists right now is because you have a surplus of dollar liquidity in the system. There's actually a recent tweet that I put out where it was talking about how China is, putting out a lot more stuff, or they were tokenizing a lot more things on their blockchain, or on the BNB blockchain, and they're trying to basically get liquidity for some of their assets. And let me pull that up really fast because this is really interesting. Let me snip this tweet. Hang on 1 second. When you have things like this is not neutral, right? That China merchant banks have officially tokenized a $3.8 billion fund on the BNB blockchain. Like that's a large amount of money, right? And that in itself is not neutral. I mean, you better believe that the U.S. administration is very well aware of that dynamic and those changes that are taking place. And so, that is, that can be, we don't know the full picture behind it, but, China continuing to try to get US dollars, because China itself is running a closed capital account, right? Which means that, the people that are in China and they might have capital, you and I can go to another country, or, whatever country you're in, most countries, a lot of countries. And you can say, oh, you know what? I want to invest in U.S. assets, or, I live in the United States. I can say that, oh, I want to go invest in the German economy and buy the DAX, right? I can go and do that, right? In China, they don't have that ability, right? Like they have a closed capital account where people can't just go take their yuan and convert it to dollars and then buy, just the S&P or things like that. There's ways that people try to find around it, but broadly speaking, there's a closed capital account, so it's not just free flowing. And that's why they're managing their currency the way that they are. So the question is, how do all of these changes that we are seeing take place connect to macro liquidity? And, it has been my view for a while that gold is bullish. I ran along, and I put this on the Substack and everything, basically right before Jackson Hole, right here, just saying, hey, I'm getting long into Jackson Hole. Jackson Hole really set the low for gold prices, and we have just been ripping since then. And I think we're just going to continue to rip until we have an actual catalyst that sets the top. So, my view is that we are going to continue to see that take place until geopolitically something changes. Now, you'll notice here that, kind of circling back to what we were talking about earlier, we are back at these levels where we were at in the April sell-off with the amount of rate cuts that we have priced. And we just have short end rates for ZT, and then we also have ZN back at these levels, almost about to, likely make a new high right here. The question is, and you have UB here as well. We're still a little bit below that, but the strength that we have been seeing and compressing in this range for bonds has been, pretty significant. And so, the fact that we have bonds pushing up here, and you've had these pushes right here on an intraday basis, I'm watching this correlation with equities really closely, because it's still my view that we're going to remain above these levels right here, the 6,600 level and that range. But if we can't really hold those levels, and you keep having the VIX break out to new highs and other shifts taking place, then the question is, are we moving back down to a VIX 16 environment, or are we going to have this new environment of VIX at 21, 24, 18 and fluctuating in this range? I think broadly speaking, if you have vol higher now, and that's kind of a new thing that's taking place, if that's the case, then you have to make more active decisions in markets trading to be able to have the same amount of returns, right? If you have volatility in markets, typically speaking, you need to make more decisions to be able to maintain the same amount of returns if you're if you're not on the right side of a trade, especially for positive carry assets like the S&P. So, my view continues to be that we have a really clear risk reward, where the tariff news that took place the other day, that was unlikely to persist. And I laid that out in a report on Friday. And my view is that, we're going to continue to hold these levels if we don't have additional tariff kind of fright around people. And so the entire question I know a lot of people have is, okay, how does all this connect to Bitcoin? And I'm going to pull up a couple charts on that. If you guys give me one moment, and if you guys could just retweet this Spaces in the live stream, and then also share it with whoever else you might think might want to watch it, and then throw anything in the comment section, I'd really appreciate it. I am going to, let's see here. I am going to pull up the report that I just wrote on Bitcoin, and I want to walk you through that a little bit, because I think understanding that will be very helpful. Let's see here. All right, give me 1 second. All right, so here's the Capital Flows website. Again, if you didn't catch it before, I'm going to walk through the Bitcoin report and explain that a little bit more for how all of these views that I've been talking about really connect to everything. But on Friday, this Friday at market close, there will be a price increase on the Substack. And so on Friday, it'll move to 135 or 1,300 a year. If you subscribe before then as a paid subscriber and lock in the price, you get all the upside at the lower rate and all of the future models and research and everything else that we are going to have. And then also, if you subscribe today, you get the two reports that I connected here, which is a macro report explaining how to think about all of the economic data with government data being offline, and also the risk manual. And you can find both of those here. They're both behind a paywall right here for anyone that subscribes today. And then also you have all the educational primers right here. Those are all free. So on the website, like I said before, all of the educational primers are free right here. There's an entire primer and playbook on Bitcoin with a connected script for TradingView right here. This is like 100% free. You can just go to this anytime. This is how I've built my Bitcoin strategy for trading it. And so all of these educational primers are free. And I always encourage people, go to those first before you become a paid subscriber. and just be able to think through all of those and set a good foundation, that's going to just set you up so well just for everything in markets and life. All right. So the recent report that I wrote on Bitcoin, and I want to walk you through this because this will frame how macro liquidity and the tariff situation connects to Bitcoin. Bitcoin has functionally been range bound since July, creating frustration among investors who hold outsized positions in assets. I think one of the key things is that, I'm not a big diversification guy myself. However, if I am using leverage and I'm, doing something, I'm not on sides, then you have to be really aware of other assets and how they are taking place and how the flows are functioning. I do not, just to be very clear, I do not subscribe to this idea that I only want to be long Bitcoin and I never want to be long equities. I don't subscribe to that. I think that in a world of leverage, the way that you think about everything changes, because I know that I can be leverage long the S&P and make similar to even more returns than I am in Bitcoin during certain periods of time. And people are going to say, oh, you're taking on more leverage, that's more risk or something like that. If you have good risk management, losing money is losing money, whether it's on margin, the same amount on margin in the S&P, or if it's the same amount in Bitcoin on spot. I mean, losing money is losing money. And the central question that everyone is asking is, are we going to keep chopping sideways, or are we going to break lower or finally surge to $150,000? And what I will say is that all of us have, I think all of us in the industry, Bitcoin has kind of created this expectation that it's going to go up over the long term. I believe that, right? Like what we're seeing in the world, everything else, like, sure, I think stocks are going to go up over the long term too. The question is, what is the path that will take for us to move up over the long term? And so again, you can find the entire Bitcoin playbook right here. You can download it. That's 100% free. And then also the Trading View indicator, which I'll cover in a minute. And then also some of the Bitcoin strategy reports that I've written. And then, I did a quick note here on the locking in the lower price before Friday. Okay. So you will notice that the Bitcoin maxis, and I don't know if I'd consider myself a maxi, but the Bitcoin maxis display extreme confirmation bias when analyzing Bitcoin's price action. When predicting its price, the key point to understand is that Bitcoin operates along the risk curve of other assets. That's just what the price tells us. It correlates with equities because it is a risk asset. There's a clear reason that gold has rallied so much year to date, while Bitcoin has not. And I mean, this just in itself, just think about this for it in itself. I think what you will have is you will have a maxi just say, oh, well, the fact that Bitcoin is rallying is actually an indication that I'm more right and that Bitcoin will eventually rally even more, right? And they will not take the fact that, okay, well, it's actually possible for Bitcoin to maybe outperform or for gold to outperform Bitcoin during a certain period of time. What does that signal, right? And if you consistently reject evidence that might falsify your thesis, then you are never going to refine that thesis. That's why I think in the space overall, and I don't mean this in a critical way, but a lot of the maxis, kind of their response to everyone is like, well, you should have bought it when it was $10 like me. And they just kind of keep throwing out the same narrative of Bitcoin going up over the long term, which is totally fine. I agree with that. But it has less asymmetry in it than it did when it was at $10, right? Or $100, right? And so, it's easy to say, oh, you should have bought Bitcoin when it was at $100, right? And that's kind of their baseline for every argument. When, if you want people to buy Bitcoin with the expectation that's going to go up over time, then, and you want it to be integrated into the traditional financial system, then you have to begin to understand, okay, well, how are those relationships going to be set? And so the key thing I would think about is let's understand the macro forces. Let's begin to break down how and why the price of Bitcoin moves from a fundamental perspective instead of just kind of crapping on people for not buying it, however many years ago. Which, disclaimer, like, I didn't buy Bitcoin at $100. Like, most people in this stream did not buy Bitcoin at $100. And that's totally fine. Like, the differentiating factor in you making wealth in life has more to do with you than you buying a single asset, right? Like you are the asset in your life. Your ability to generate dollars that buy assets, right? Like that's more important than any single asset that you might buy. And so let's talk about Bitcoin as it relates to the S&P. Bitcoin outperformed the S&P, rallying off the April lows, but then began to underperform in July, which began to set the stage for its neutral range. So you'll notice here in the chart, and I'll switch back over to Bitcoin in TradingView. You'll notice here that we had Bitcoin outperform in May, as we moved off the lows. And then as we moved, these shaded backgrounds show when you're outperforming the S&P 500, and then the red show when you're underperforming the S&P 500. And so we had, period of outperformance here, then underperformance, short period of outperformance, and then more underperformance. And you can see that these periods of time take place pretty frequently. And what I would say is that understanding those periods of time and how they're taking place helps you a ton if you're trying to establish a cost basis for Bitcoin. And so the other thing to note is that Bitcoin is also underperforming the Russell right now. And the reason why that matters is because the Russell has a lot more cyclical components in it than the S&P 500. I mean, the S&P is the Mac Daddy that has all of the tech names, right? It has Mag 7. The Russell doesn't have that. It has all of the companies that are like the basic businesses in the US economy that are impacted every single day by the labor market, by interest rates and things like that. When the Russell is rallying, it tells you that growth is actually pretty strong in the US economy. And so we've also seen Bitcoin underperform that. And then we're also seeing Bitcoin underperform all of the names on the far end of the risk curve, like the ARKQ ETF that is focused on tech and robotics. In 2021, the ARKK ETF, and you had all these like lockdown, names like Zoom or whatever else, Carvana or whatever else it might be. They were the ones that had a lot of capital put into them, and they all rallied with Bitcoin as well. Now you have investors saying, okay, if I need to make a decision about, what has the most upside, do I want to, and it could be an investor that says, okay, I have, $100 million I need to deploy. How much am I going to put in Bitcoin and how much am I going to put into robotics and tech? Well, if they think robotics and tech is going to go up 100% this year and they think Bitcoin is going to go up 20, they're going to put more in robotics and tech, right? Or they're going to vol weight that in a certain way, right? And so that, all of those returns are temporally dependent, which just means that people are thinking about what's going to happen this year, right? And that's why you have outperformance and underperformance. Check out Citrini's note. This was a really good note covering a lot of the AI names that have taken a lot of money, but what has happened exactly in Bitcoin year to date? And here's what I will say. There's two major reasons in my view. And again, you can come and read this report on here as well. Macro liquidity is expanding, but it is clearly moving into things like gold, silver as real rates fall, and into robotics, AIs, and the semi-spaces as equity beta. So if you think about Bitcoin, it primarily correlates with what? Equities, right? Like Bitcoin does not correlate with the VIX or with cash that would function as a reserve asset, right? It functions as a liquidity release valve primarily for equity beta, right? Like that's why you begin to have treasury companies and other things. They actually are increasing that connection to the correlation with equities. When you have the ETFs for, back in I think it was 2021, we had the ETFs launched for the futures. And then more recently, we had the ETFs launched for the spot. Those integrate Bitcoin into the traditional financial system. And so that creates more cross-collateralization. Whether people like it or not, Bitcoin becomes cross-collateralized with different assets. And that begins to integrate Bitcoin into the equity beta flows that take place, which just means that every single equity functions on a risk curve, right? If I want to buy an asset, I can buy the S&P 500 Or if you talk to a regular financial advisor, they'll say, oh, you could buy the S&P 500, or maybe you could go really risky and buy a sector ETF, or maybe if you're really on the edge, you might want to buy an emerging market ETF or something like that, right? And then if you're kind of more sophisticated, they say that you can buy individual stocks, and that's really on the far end of the risk curve. But that risk curve exists in markets. And so the key thing to remember is that money always is flowing to different assets. And so more money has flowed to AI, robotics, and semis in the equity space than they have to Bitcoin and Bitcoin treasury companies. The second thing is that the entire outperformance of Bitcoin off the April lows were linked to a wave of treasury companies trying to replicate Michael Saylor. And this has been my view actually for a while. It was not very popular for a while. But, one of the things that I said is, how much of the changes that we are seeing are just linked to, people front running treasury companies, right? And, when you have everyone with the expectation of, oh, there's going to be a lot of treasury companies outperforming, how much of the outperformance that we saw off the April lows was just people expecting treasury companies to buy more Bitcoin? As that is priced in, now we have, kind of this whole thing retrospectively where U.S. regulators are probing stock moves before companies made, crypto treasury announcements. Where, if you are, aware at all of any of the treasury companies for, any of them for Bitcoin that are buying, significant amounts, whatever that might be, and you're either being one of the persons that is buying that and running the company or aware of that, then you're going to try to front run that, right? That's something that people are always trying to do. Give me 1 second, guys. I just need to adjust something. All right. So those two things have created a setup for Bitcoin to have these short-term tops, right? And my view has been that once Bitcoin on a marginal basis begins to outperform these other names and set a higher low, that's when we're going to begin to see more outsized returns in Bitcoin, which we actually saw, if you notice right here, as we rallied, you actually saw this take place in the rally in October, right? When we pushed up, you saw it marginally take place against other sectors first. You saw Bitcoin begin to outperform other names first. And that's what this chart shows, right? Now on a weekly basis, and I'll go over to the trading view chart in a moment, we're back down at these levels and we are, in the outperformance moves, we're not setting higher highs in the price. And that's really key to note. I'm going to switch back over to trading view and cover where we're at with Bitcoin right now. So give me 1 second. Hang on 1 second, guys. Okay, so we have had, let me pull up Bitcoin here. What just happened? Let's see. Here we go. So we have had Bitcoin outperform a little bit during this period of time, which began to signal the further upside. And then it began to underperform right here, those other assets that I noted, and we began to move to the downside. What I'm looking for right here, I don't really want to be short Bitcoin. I don't think that's the play right now because macro liquidity in the system is still expanding. And it's not really what I am interested in betting against a macro regime like that. What I'm looking for down here is Bitcoin to begin to outperform those other assets that I noted in the report. And if you go to the Substack, you can see the breakdown of the other assets that I listed there as, what it is outperforming. And, again, we'll see, for the Bitcoin price to begin to move, I would want to see Bitcoin begin to outperform gold a little bit, right? When we have, here, we'll actually shift this. So we have the same time series. When you have Bitcoin outperform, right? Like, the fact that we have it outperform right here caused a little bit of selling maybe. And the fact that we're moving up here in gold and then Bitcoin's moving down and then gold's moving up here, Bitcoin's moving down. I'd love to see this relationship begin to flip on a marginal basis, right? Because once that begins to flip and we see gold break a couple levels or just consolidate as Bitcoin finds a bid, that's going to begin to provide more support for the Bitcoin price. But right now, everyone's looking at gold and just saying, you know what? If equities go down, Bitcoin's probably going to go down. If equities go down, gold is probably going to rally because it just keeps rallying. So I'd probably rather buy gold here than Bitcoin just because it gives me exposure to the macro regime. It's trending up and it keeps rallying on equity moves down, which means if I'm holding equities and gold, then if gold rallies and equities fall, it's actually offsetting my equity drawdown. That's just how investors and traders, institutional money managers, everyone is thinking right now. And so those are all the incremental things that we see taking place every single day in the price. And so, my view is that we need to see more of a shift in the price of Bitcoin to, clearly regain these levels, right? And have it begin to shift in its relative relationship to things like the S&P, things like the Russell, everything else, right? So those are the things that I would be watching. The other thing is that, we have had bonds rally a bit in this move down in Bitcoin as well. And so watching bonds here is going to be really key. Because if we can flip that correlation, let me pull this up. All right. If we can flip this correlation, that will be really key. You can notice here, earlier this year, we had, in July, Bitcoin rally and bonds sell off, right? And then the opposite, right? Kind of convergent of relationship a little bit right here as we moved into September, right? But now what we are seeing is bonds bidding and Bitcoin falling. So one of the things that I would be watching, especially for the most recent move, is bonds to fall from these highs if I want to begin to buy a bottom in Bitcoin, especially with leverage and size and time that correctly. So that's how I would be thinking about that. Look at the relationship of it to other assets, right? Like that is the key. Broadly speaking, for the S&P right here, we're compressing in this range, especially on an intraday basis. And my view is that we are going to, remain above these lower levels, and that these tariff news are going to chop around a little bit, but we're going to drift higher. The question is, are we going to have these larger ranges as the VIX stays elevated? If that's the case, then the entire thing and play will be to size down a little bit and be able to take more strategic trades if we're going to have wider ranges. That will be the key. So that's how I'm thinking about that period of time. And I'm going to go over some questions. So if you have any questions, you can please throw them in the chat and we'll start covering them. And then again, as a reminder to everyone, if you're watching this on the Substack, you have the Bitcoin report, and then you also have the announcement that on Friday at market close, there's going to be a price increase on the Substack. So if you subscribe before then, you get to lock in the lower price. And there's also a risk manual and a macro report on there that you get if you lock it in today. All right, so a couple questions that I want to go over here. Hang on, let me just scroll through these. This is very interesting. Yen carry trade unwind. This has been a very interesting setup that we have been in. And let me explain it to you. What we have had is the yen rise a little bit over the last couple days. And you'll notice that right here, you had this gap down in the yen. Why did that take place? This was the release of the announcement about more fiscal spending in Japan, mainly because of who would get elected. And you had this gap down in the yen. Just think about it as Japan just said they're going to spend more money. That means there's going to be more yen in the system. So the yen lost some value and gap down. And that's why you had, as the yen gap down during that time, you had the Nikkei gap up. And, we kind of sold off from that time, rejected this level, and now we're moving back up here, which I think we're just going to continue to push to all-time highs. That's my view. So the setup for the yen here is I am watching this closely because if you have a rally here in the yen and also in JGBs, which we're seeing marginally but nothing crazy, that's what really can cause US equities to fall. These spikes right here, when they overlap with the yen rising and the VIX, you can have some pretty significant carry trade unwinds. So you'll notice here VIX is spiking with JGBs, VIX here, and then we have a kind of a similar setup in some of these changes. So I'm watching these really closely right here, especially through the Asia session. And the Nikkei usually leads to the downside in the Asia session as JGBs bid. So that's how I'm thinking about a potential carry trade unwind. All right. How do you trade trending assets? This is great. You basically, in a very simple sense, let's just use gold, for example. Like you are just going to functionally use more, there's some trade-offs to this, but you're going to use more of a CTA trend following approach. That's how you trade trending assets, right? Because if you are long gold, right, which I have been, I'll kind of explain how I've traded this. If I get long gold here, and then we move up, what I would do is then set my stops and roll them to protect my principal and some of my profit. And as long as we keep showing positive returns, you can show like a, hang on, let me see if I can find this. Yeah. You can see things like just an ATR or a moving average cross where you say, okay, what period of time do I want to look at? Let's look at 3. My multiple is 2.5 just for vol and things like that. Okay, basically I want to get long here and I want to hold until we break, this would be my level, right? The upside of this is that you hold assets that trend a lot. The downside is you get destroyed when things are chopping. And then the other downside is that when gold finally tops, it's going to come back down, and it might come back down a ways, pretty significant gap before it hits your signal to get out. The upside is you get to hold kind of a banger trend trade. So you can just look at, like ATR strategy or moving average crossover strategy. That's not the exact way I play it because I have some other models that run things a little bit more dynamically across multiple time frames. You can do stuff like that. Here's what I would do. Or this is not investment advice, obviously, but have a higher time frame look back, right? And let's go even higher. Let's see if this works. Don't think it works. Let's see. Yeah, what I would try to do is look at it on multiple time horizons, right? And then scale position sizing accordingly. Again, I'm not sure. I don't use this one very much, or I don't use this one at all. But, you can kind of look at these longer time horizons and say, let me look at things on a 4-hour chart. Okay, now, I can get long here, or I'm trying to buy breakouts as long as we remain above these levels. And then you have these, kind of flush outs right here. Again, this was, actually pretty important to know why that was taking place, because that kind of hits some trend levels, and now you can kind of keep just holding right here, right? Like that can be kind of like one of the ideas. So that's how I would trade trending assets. All right. Other questions? Do I think that traditional modern portfolio theory is dying? Here's what I would say about that. I don't think that it was ever really alive. I think that, the portfolio theory is more about accommodating to financial advisors who don't have the skill or the tools to actively manage risk in markets. And, well, I'm sure that maybe back in the 80s or 90s it was a thing. But I think a lot of things have gotten a lot more sophisticated since then, especially in the hedge fund space. The institutional side, that like institutional money managers or a lot of long only funds, right? Like they're just trying to, have expressions of beta, right? And hold kind of like all these different assets and things like that. And I would say the active space has gotten a lot more sophisticated as it's also shrunk as well. So I don't really believe in it. I honestly don't even give it much thought overall. So, everyone, I just watched actually Brian Harrington's podcast with Ski God. He has a lot of great points on Bitcoin. You guys should go check out his podcast, especially I think if you are him and Ski God are both like dad life, hanging out. I think involved in markets, involved in Bitcoin and things like that. You should go check out their podcast, or it's Brian's channel. They have separate podcasts and channels and stuff like that. But check out Brian's stuff. He has some like cool stuff. All right. With the Fed lowering interest rates and stopping QT, will bonds continue to bid significantly? So I think the QT thing is not a really big deal in my mind. I think it has more to do with how fast does inflation begin to accelerate and when does that take place? That's really more of the question in my view. It's less about, okay, well, is the Fed going to shift its stance to buy or sell more assets? Because I think that the amount that they're doing is not really consequential in my view, like broadly speaking, right? The Fed has been shrinking their balance sheet for a while now. Let me pull up a chart of it. And this is actually great because this goes back to understanding Bitcoin. The Fed, people kind of move the goalposts a lot for the Fed and the Fed balance sheet and things like that, because, you have the Fed has been shrinking their balance sheet for like a pretty long period of time now. And Bitcoin has rallied during that time. Now people care about it because they're like, oh, wait a second, maybe the balance sheet is causing Bitcoin to underperform. No, probably not the issue. But you'll notice that the balance sheet of the Fed has been contracting since, functionally the middle of 2022. We had the spike for the SVB thing, but we've been contracting since that period of time. They've been letting assets roll off their balance sheet. They've been selling and things like that. So the thing that I would think about is, how is long-term nominal GDP impacting the long end of the curve? That's going to be more important to understand than right now. The actions of the Fed are pretty narrow in my view. And so we'll see kind of how they begin to play out. But I think they're pretty narrow overall. All right, let's go. What do I think about the upcoming Supreme Court ruling regarding Trump's ability to implement tariffs? I don't have a strong view on it. I think that overall, they're going it's very challenging overall to block, to have a consistent blocking of regulation from these types of things, right? Because the tariffs are already kind of in place, right? Or a lot of them are. And the regulatory side is something that's very challenging to use. I would encourage everyone to go read the book, Why Nations Fail, because regulation is one of the most important things to transmit the flows of capital. So we have money in the system, but regulation is one of the things that causes the distribution of it and where it goes. So I would encourage people to check out that book. We will kind of see how that ends up playing out. All right. What are your thoughts on European yields right now after this slide. Hang on. All right. For European, we'll just go to, Germany. My view is we're seeing a bit of a positioning unwind because we have been, compressing at this range for a long period of time, right? And compressing at these levels, and now we're kind of bidding off of them in Germany right now, which, you'll notice they're bidding off those, and we've kind of come off the highs in the DAX a little bit. I'm looking for the DAX to kind of bid back up, especially in the London session tonight. I would be looking for that to bid. But, my view overall is the ECB has been tighter than the Fed, which actually decreases the probability of inflation accelerating over there relative to the United States. And that I think that, European bonds probably have, decent room to actually bounce a little bit here. All right. Do I have views on the banking system tightness? Higher rates paid by banks, or SOFR seems to have started prior to the Trump-China thing. The level of rates, pretty important here in my view, because these level of rates have overlapped with, cycle lows in credit spreads. So we're not seeing financial conditions remain tight, right? Like credit spreads are at lows right here. Like we're not even at 2022 or earlier this year levels, right? We've come off the lows barely, but nothing significant, right? So this means that financial conditions are still really loose, and we're not really having a major issue in the system yet. So that's what I would kind of say about that. On Euro USD and the pound, my view is that as U.S. bonds rally, you're probably going to have the euro rally here because U.S. bonds are probably going to rally a bit more, or just on a marginal basis to Europe, in my view. And so you can have Euro USD begin to push up a bit higher. And that's kind of my view for, euro and the pound, especially above these levels. The high was really set at the last FOMC meeting. So I could see us bidding into the next FOMC if Powell comes out and pushes back on the market with how hawkish we are. Then, you could have a pushback down or something like that. That's kind of how I'm thinking about that. Is there a ROC primer to better understand your data in the global macro reports? Honestly, I would say ChatGPT. You just ask ChatGPT to give you a breakdown of all of the source data. And, something I've had to do over the years is go through every single economic data release, like go to the BLS or the BEA and BLS website and read through the manuals on the data. It's super boring. Honestly, it's just really boring. But if you do that, you get to understand what the data sets are, what they represent, and what the limitations are and the implications you make from them. That's what I would say. What are the rate differentials between spreads between the US and Euro? What's driving this? I will write a report on this, especially, if you're a paid subscriber, I'll write a report on this because this is something I've been thinking about a lot recently. And this and the setup with Japan right now is super important for where we're going with macro liquidity. So I'll cover that in a report on the Substack. What is your long-term view on Bitcoin with the changes in the U.S. making in the global trade system? My view on Bitcoin is that it's a great asset to own. And the question is more about, I think about Bitcoin as a liquidity release valve for all sources of liquidity in the system. And so the idea behind that is that we can have periods of outperformance or underperformance. I think one of the things that is kind of people throw this dollar devaluation narrative out there all the time as the excuse for everything. It's kind of funny because if Bitcoin goes down, or if like Bitcoin's going down right now, like on a weekly basis, does that mean that there's less dollar devaluation in the system right now? Is the Fed not printing money right now? Or is there less debasement that I don't need to worry about? Right? Like those questions don't really get answered by maxis because they'll just say like, zoom out, bro. And, in reality, you can zoom out to any time horizon, but then that just comes back to, well, you didn't buy it in 2014 when I did, when it was smart to buy it. And I'm just like, okay, well, I'm operating in the present, right? So my view is that Bitcoin, the returns for it are probably going to decrease a little bit, especially relative to history. When it's financialized, it's going to have a lot more mean reversion and choppiness. So the types of trends that you saw here in 2021, very challenging to get those same trends in this period of time here, right? Like we've had some uptrends, but you'll notice we just chop for a while, uptrend, chop, reverse. Like this is a very different trend here than like this right here, because this is just like straight up and to the right. And then the moves down that we saw were just like leverage in the system, right? So, and then, the fact that we just saw this, I mean, this is like the perfect kind of like, bubble kind of depiction people use, right? But now when it's maturing, it's going to have a lot more mean reversion in it. So that's really important to understand. All right. What's your take on the DAX? I think it's going higher. Also, will unwind of the AI and quantum thematic trades be bullish for Bitcoin? Probably not, unless equity indices continue to rally. How do you identify a trend? That is honest. It's kind of funny. It's like a secret of the universe almost. Not because I have a secret, but that's what like every quant wants to know. There is no definition for a trend. There is no optimal. There's no specific look back that you need to use or something like that. There are no rules. How do you do intermarket analysis? Read some papers on cross-sectional momentum. Those will break it down for you. You did not, Thread Guy. Thanks for joining the stream. We got to get back on a stream sometime soon and chat it up. But which you guys should follow all the stuff that he's doing. Thread Guy. He's got some cool stuff out there. The catch up for Bitcoin is not here yet. Not here yet. Does the all right, let's see. Do you think that the following rate cuts have been priced in? Well, the ones for this year have been priced in. So those are already priced. And it doesn't matter what I think. That's what the market's saying right now, that they're priced 100%. So the question is about 2026. What do you think about the reverse repo market? I think it's there and it's a market. And I would go to all of the conks stuff for that. And I'd also say that the short end plumbing is important to understand, but it's not the full picture. And conks would say that and everything else. So yeah. All right. What do I think about regional banking situation? Do you think it's real risk? So the regional banking situation, we've rallied off these levels right here. I would be watching for regional banks if they begin to diverge from equity beta a lot more. They're not at the moment. I think, we were down in the day, but I'm not super concerned yet. So I'll be watching if we begin to make, more lows. And then especially if we have like financials push lower, like actually push lower in, let's say, like this whole kind of like setup and we take out these lows that we had right here, then I would take a little bit more caution. Awesome. Glad to hear that, guys. I'm always happy to hear that things are going well for people and everything is super helpful. The books that you recommended, did you actually read all of them, and how long did it take you to read all of them? I don't remember off the top of my head how long it took me, but every book that I've ever posted, I have read. And I would say 50 or more % of them I have spent a lot of time in actively making models on. And I think that you want to read every single book that you can on kind of like what is taking place, especially technical ones, and then figure out how to come up with your own ideas, right? I think that just remember that, you have this whole idea of, you look at someone like Jeff Bezos or Steve Jobs, and, if Steve Jobs was around today, he wouldn't be thinking about, oh, let me build an iPhone or the next iPhone or something like that. When he was, back in his time, he was thinking about how to take a bet in that period of time. And if he was around today, he would probably be working on AI and a new company related to that. I think the thing is you want to read these different people, but you want to come up with your own creativity and you want to come up with your own independence in that thinking. And that is what differentiates people, because they're able to take what they need from the past and from other people and be able to go out on their own path and be self-reliant. All right. What would you say every FX trader should start daily by looking at the STIR curve to inform their views on FX? I think you want to look at all STIR contracts, all rate differentials, cross-currency basis, stock-bond correlation differentials, and the strength across all of those. That's where I would start. All right. How do you manage risk if your signal to switch sides considerably lower than your current price? So let me just talk about risk management in general. I think that for risk management, you always want to have a very clear and defined setup for how much money you're going to make and lose in every situation. And also, anytime I approach a trade, so if I say like, oh, I want to get long the S&P here, and I say, oh, like this would be a great setup to get long the S&P, like how can I get long here? I would think, okay, how many times do I need to run along to make money in the S&P? So if I get long, get stopped out, get long, get stopped out, get long, it goes in the money and then it pays out. How many times do I need to trade that to make money overall? And then I will always, if something's going against me, I will incrementally scale out and decrease exposure. And then as something goes in my favor, I'll add exposure. So I think that you want to ideally connect your risk management actions of adding and taking away exposure to signals that are across each time horizon. So if you have signals across each time horizon, then you can kind of add and take away exposure through those time horizons as well. All right. All right. I am 17 now and want to start to get into macro and economics. And how would you start? I know the educational primers and book recommendations. How do you get into it? Here's what I would do. Number one, I would go to all the educational primers on the Substack, like you mentioned, and I would read through all of them. And as you read through all of them, let me just link a picture here. As you read through all of the educational primers on the website, again, this is just the main page of the Substack, I would have a Word doc open. And what I would do is, as you read through things, every single thing that you are interested in, write down and study it more. And then every single idea that they lay out that you think, oh, that sounds really interesting, let me go figure out how to do that in markets. Have a list of models to build and go create a list. So when I was reading through some of those books, I just created a list. I think my Word doc ended up being like 50 or 75 pages, like some crazy number, right? Where I had like a list of models I just wanted to build on everything, right? And not just those books, but like there's a lot of other stuff even prior to that, prior to reading some of those books, because some of those books are a lot more recent. And there's older books that are helpful in explaining a lot of them, but they're a little bit more outdated now. But the concepts in them are pretty important. But those are the most up-to-date books, and those are what I've used a lot, especially more recently of the last couple of years. But you want to go through all of those, have a list, and then build models on every single idea, and then just test them and understand how they work. And then just keep doing that over and over and over. And eventually, after you build a base of knowledge over time, you'll begin to see opportunity with more clarity. All right. Over the next 5 years, are you in the camp of an oil glut or an oil squeeze? What factors are most important in this realm? AKA, will oil follow commodities? Um, here's what I would here's how I'm thinking about that. There's two sides of oil, obviously, supply and demand. Historically speaking, the largest rallies in crude usually occur with supply shocks as opposed to demand shocks. It just so happened that during COVID, we had a supply shock and a demand shock at the same time, which is pretty wild. And we had supply shock, demand shock, where both of them went in disequilibrium, where you had demand come back online where there was no supply. And so the thing that we have is, my view is, like, over the next, let's say 5 years, like you said, 5 years, I think we're still going to remain range bound in the oil chart. Pull this up. So my view is that, broadly speaking, I don't think that we're going to move back down to like these lows right here or move back up to the new highs. I think we're going to be chopping in this range, and I don't really see us, taking out these highs or taking out these lows or going negative or anything like that. So that's how I would kind of be thinking about it overall. How did you learn coding for models? What I would say is that just start on TradingView and then start in Excel with Fred data. And then I would say you can manually backtest things. You can just ask ChatGPT how that works. And then, I don't really code much these days, partially because I'm not very great at it. So I have someone doing that full time for me. So I would just say, if you can work with someone, if you're good with working with people, and if you can work with someone who understands how to code and you can kind of come up with ideas, that's like a great situation, even if it's just for learning and you guys are both excited about markets and want to learn together. That's what I would say. All right. Awesome. I really appreciate it. Glad to hear that, Rodrigo. Hope everything is well with you guys. I don't think, Flows, do you think the ETFs have pushed Bitcoin further out the risk curve? No, I just think it's financialized Bitcoin more, so that you have this little bit of a shift taking place where it becomes more difficult for the price to make extreme moves in either direction. That's how I think about that. I basically will trade everything. I focus a lot recently on equities because I have not wanted to be short or long bonds aggressively. And I will primarily focus on rates and FX and equities, but I will basically go to wherever I think that there's opportunity, because I think that all assets are connected. I think every single thing is in this, kind of system, and I'll go wherever I think the most upside exists. All right. What role or part do you think God plays in markets, if any? Good question. So here's what I would kind of explain. I think the market itself functions in the same way as the entire moving parts of the world. There's just more quantification in the market. But my belief and conviction is that God is sovereign over everything, and he is the one that has created the entire world in the way that it is. I think that if you go in the Bible and look at Genesis, where God creates space and time, there was an absence of time that existed before God created it. And the fact that we model time and time series and these changes in different moving parts through time, I think in itself points to the presence of a creator and who he is. And so I think God is sovereign over all markets. But I think that markets operate off of supply and demand in the same way that, we still have, the basic things in reality that operate off of gravity and physics, right? Like, those are things that, God has created. And I think that God's always sovereign over those. I think that, on a personal note, if one of the most important things that you can do in markets or just in life, if you're taking risk, is to have a very clear understanding of who you are, what you believe, and what your convictions are, which by definition means introspection and reflecting on who you are as a person. The only way to get a really clear view of yourself as a person is through scripture and reading the Bible and understanding how God has communicated to us, because he's the one that has actually created us. So I'd kind of like to hear about, who I am as a person and how I function in the world from the person who actually created me, not kind of these other views that are going around right now where people are kind of talking about their different worldviews. So I think that God is always sovereign over that. I think that the ultimate goal I have in life is my relationship with him and being who I've been created to be, and not some other thing about making some dollar amount or whatever else that people come up with these days. So that's what I would say. All right. Let me go through. Awesome. Glad to hear it, guys. I'm very happy to hear that. Looks like we're going back and forth between these questions on markets and faith. What motivates you to help people so much? Does it have to do with your faith? Just something I'm super intrigued about. I think that, I've put out a lot of educational material. I've done a lot of educational stuff on the Substack for free. I think that's twofold. One is that I know what it's like to basically have like no help from anyone and try to have to figure everything out on your own. And you have to really be self-disciplined, not only to get, sift through all the garbage and sometimes pay fees and stuff like that when you're, least able to, right? Like all of us have been broke at one point or another, right? Like basically 99% of everyone on Twitter or on social media or anything like that, like just how the world works, like all of us started broke, right? Some different countries, some different opportunities. All of us started one place. If you have the internet and you have a mindset for discipline, then you have the ability to improve your life. So I think that fundamentally it does start with my own faith, because I just believe that, I'm called in life to, one, have a strong relationship with God because he's the one that's made me. And then two, to be able to love other people and care for other people and have that tangibly reflected in what I'm doing, right? None of us are going to be able to help everyone, right? But all of us have the ability to help people in the way that we have, right? Like, and I do feel like that's one of the reasons I will try to do a lot of stuff for free for people, and put out a lot more free content, because I just think it's, I've had so many people bless me in my life and help me for free, or people take bets on me when they didn't have to, right? Or people just give me stuff that I didn't need, or deserve or anything like that, right? And so I just think that's super important. I think that reflects who Christ is and what he's given us. And so I always take that. I don't take that for granted. I always think about that, and I always try to make that a priority. So that's how I would say about that. All right. Let's see. Do I have any thoughts on Binance's alleged manipulation? Well, I guess I'm probably not going to get a sponsorship from Binance after saying this, but not that I'm trying to do sponsorships. But no, I don't trust Binance overall. I think that, they've done a lot of shady stuff in the past. I think that the entire question about how they're running their order book and things like that has a lot of questions around it, and how clear that is reflection of the market. Mainly because all the crypto companies, right? Like there's no, because of how they have their accounting to have lower fees, right? Like if they're going to have lower fees, they need to net out their accounting on the back end somehow. And that doesn't mean they're doing something malicious, but Coinbase does this too, right? And I think Coinbase is actually a great company, but they're not putting everything in an individualized wallet for every single person, or else they couldn't offer the fees, right? They'll have things move around in the background, and then if you want to take your things off exchange, then you can, take it in a certain way, right? But my view is that I do not personally trust Binance. Happy to have my mind changed. I could be wrong on that, but I would not be surprised them or FTX and all that stuff, like being involved somehow and manipulating things. Like I would have no doubt. Do you trade intraday as well? Sometimes, not as much frequently. I have intraday execution, but I'm not like day trading in and out of things. I don't think it's possible to be non-religious while trading altcoins at 100x leverage. It's pretty funny. All right. To get hired in the buy side, do you think CFA or an academic qualification is necessary, or learning about how markets work, cross-asset understanding stuff like that is better? It's so tough today, because I would just try to figure out how exactly, you can, set, like, what are the people that are in the role that you want to be in, right? Like, where on the buy side? Is it an analyst, a PM, compliance, risk? Like, what does that look like? And I think it's very challenging to get on the buy side today. And I personally think that, the thing to do, like in the 2000s, was trade mortgage-backed securities. And then the thing to do in the 2010s was either to be in the prop space after 2008, because you had all the prop desks closed down in the banks, and to go into the prop space, or into the buy side because there's a little more opportunity. Everyone went from the sell side to not everyone, but a lot of talent went from the sell side to the buy side. I think a lot more people are, things are getting more consolidated in the buy side. I think it's changing a lot. And I think that you really have to think about where your talent is being used, because it's very challenging to get a job on the buy side today. Regardless of like how good you are, right? Like you can be really good. It can be still very challenging. So I just think the best thing that you can do is, if you're trying to get a role that requires that qualification, then just do it. I think a relationship is probably going to be very valuable in that as well. So that's what I would kind of say. Awesome. I appreciate it, guys. All right. You intentionally created a system that continually improves itself in a loop. Can you expand on that? So I think that I think that a lot of people will create strategies that are great and they're amazing and they make money, and then they'll just keep trading them because they don't want to change, because they're just saying, well, I have good positive expectancy, so why would I change? And also, like, you need to actually trade something for a while to realize the expectancy that you have around it. And so the way that I think about it is, you always want to have fundamental principles of things that you know will never change. And those should be based on how reality works, not just the presence of markets. So you want to have fundamental principles. And then in those, you want to have systems and decision-making frameworks and models that continuously improve and adapt as the environment does change. So this comes down to, how do I correctly understand what things in the world do change and what things never change? And, the media or the podcast cycle or anything like that, they don't understand that super well, because they're always chasing trends, which is fine. I mean, like, you need information to be distributed. So like all of that stuff is good. And well, maybe not the media. I don't really buy into that, but podcast cycle, I think there's a lot of positives. I think that you want to continuously adapt and learn in the ways that are changing, and then keep anchoring yourself to the things that are timeless. And I think that a lot of the principles I've created in my system and my thought process are centered around that, especially for research and everything else. They're centered around that exact thing. So that's what I would say. I think that the book, The Origin of Wealth, was helpful in that to understand that. It's on complexity economics. And then I'm trying to think if there's any other books. That's more of a technical book. But I think that a lot of it just comes through. You just have to keep embracing difficulty and learning at a more accelerated pace than anyone else over and over and over, just to an extreme. And if you can do that, then everything will become a lot clearer. All right. I think that's going to begin to wrap up a lot of the questions. If you go back in the stream and rewatch it, you can kind of see all the other kind of things that I've covered. But I've laid out all my macro views on the, in this stream. And then also, just as a reminder to everyone on what I announced at the beginning of the stream, that today is today is one of the last days before Friday market close. So tomorrow is the last day, excuse me. Tomorrow at Friday market close, there will be a price increase on the Substack. So if you subscribe before then, and you subscribe to the Substack before then, you get to lock in the lower rate, and you get all the future upside for all the new models that I'm going to release, everything that I'm going to share, and all of the different changes that we're going to have. My whole goal is just to say, hey, if you subscribe to the Substack as a paid subscriber, you get all the upside that's taking place. I basically take all the money that I make from the Substack and dump it back into the Substack with people that I'm hiring or data that I'm buying or new work that I'm, putting together, and just trying to create a feedback loop of a better product and a better view of the world so that both of us can mutually benefit from everything that's taking place. So if you guys want to join me on that, then, please, I always appreciate you guys. It means the world to me that you guys actually show up every day and, look at the content and you're able to go through it and it's helpful. That always means a lot to me. So if you want to lock in the price before Friday, you can do that. There's two bonuses, the risk manual, and then also the macro report that's connected to this. If you want to find this report, you can go on the Substack. It's published yesterday, and it just has this title, Lock in the Low Rate Before Friday Close, or you can just become a paid subscriber. And so, check that out. And again, just go through all the educational primers if that's not where you're at. Like, you don't need to become a paid subscriber if you don't want to. So that's just what I would say. All right. With that being said, I appreciate you joining the stream. We will see how markets close. It seems like we're getting a little dicey, and it should be fun. And we will see how things end up. So with that, I will catch you guys later.